Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kiryll Prakapenka and Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Magic mirror on the wall. What's the fairest metal of them all? Gold, of course. In the sixth episode of What's Not Priced In, Greg and I explored the determining factor behind the gold price. It gets a little complex, but Greg's insight is well worth it. Now, we also unpacked the latest inflation and retail sales data. Now, although a bunch of retail stocks rebounded this week, Greg doesn't think you should get excited the bottom is in just yet. We then looked at two stocks selling cheese and chicken, and one of the stocks hasn't aged nearly as well as a good Cheddar. Hello, and welcome back to the sixth episode of What's Not Priced In. As always, I'm joined by our editorial director, Greg Canavan. Greg, how are you?
Good, Kiryll. How are you going, mate?
Yeah, not bad, not bad. Well, I think today is going to be a bit of a special episode. I think some of the comments from last week did say they wanted to talk about gold, and that is what we will talk about today in detail in our What's Not Priced In segment. But I thought there were quite a bit of big events that sort of happened this week, namely with all of the releases from the ABS. So I thought we'd start there, especially with the monthly CPI indicator. And Greg, what did you make of it? Were you surprised, shocked, interested, not interested?
To be honest, I'm not surprised that inflation is falling probably a bit quicker than expected. And when I sort of looked at the numbers, one way to look at inflation obviously is the headline index, and it comes out based on the past 12-month price movement, and that came in at 5.6%. But when I did the numbers on the 6-monthly annualized inflation rate and the 3-monthly annualized inflation rate, it points to inflation falling quite quickly. So we just said that the annualized rate was 5.6% inflation, but when you do the 6-month rate annualized, it comes down to 4.5%. And over the past 3 months move, if you annualize that, it's just 3.7%. So inflation's coming down quite quickly. And I think, not 100% sure, but I think that's part of the reason why the market initially thought, okay, the RBA might not be so pressured to raise rates next week when they meet. And the other thing to consider about that is that there's two things that drive inflation, right? It's either demand or supply. So we sort of asked the question, is the inflation rate coming down because supply is starting to come back on the market, or is inflation coming down because demand is starting to get hit? And if we put some clues together from what else is happening in the market, and we saw household spending falling quite sharply, you've seen those retailers, we're going to talk about the retailers in a minute, but we've seen the retailers under a huge amount of pressure. And just anecdotally, the evidence from the economy is that people are really starting to struggle. So my interpretation is demand is really starting to slow. And that's the reason behind the faster than expected fall in the inflation rate. And then a couple of days later, we had out a better than expected retail sales number. So the expectation of the RBA maybe staying on hold didn't hang around for too long. And I think now the expectation is probably roughly around about 50-50. And we speak about this often. I got no idea really whether the RBA are going to raise rates. My feeling is that they shouldn't, purely because there is a huge amount of tightening still in the system. We talk about this each week. But on the flip side of that, you've got an RBA that is very conscious of having made a big policy error a couple of years ago, and they don't want to, and then they want to be seen to be really tough on inflation. And they're looking at two really lagging indicators. They're looking at employment, and they're looking at the inflation number. So whether they're going to feel like they're in some ways politically in a corner because they have to keep on top of inflation and want to raise rates again. But my view is they shouldn't. They don't need to. Demand is going to be hit, and it will come. Inflation rate will come down. And going back to those retail sales numbers, yes, they were strong, but the general gist in the market is that was driven by a lot of discounting, a lot of end of financial year sales brought forward. So retailers are trying to clear inventory. And if you look at, perhaps we can look at some of the retailing stocks, they've had a little bit of a bounce this week. but certainly they're still in major downtrends. So let's just get on to some of those stocks. I think it's worth pointing out from an investor's perspective, and I'll go through a bunch of the bigger names here. So starting with JB Hi-Fi, this has obviously held up really well in terms of all the retailers. And just for some context, post-COVID, most of the retailers had a really, really good couple of years. So their earnings have been inflated from the normal trend, I guess, and now we've got to work out what is the normal longer run trend in a post-COVID world where spending patterns go back to somewhat normality. So JB Hi-Fi is looking reasonably well here. It's holding up under this sort of level of support that's held throughout 2023. Now, just to give viewers a bit of context, these moving averages are the 50 and 100 day moving averages, and I just use those as a bit of an indicator of a medium term trend. So when the 50 day crosses below the 100 day, it's an indication that we're moving into a medium term downtrend. Now, that's not necessarily definitive here because it's gone above and below. So it's in a bit of a sideways trend. But as long as this support holds, that's pretty positive for JB Hi-Fi. Question is whether it can get above these moving averages, and if it does turn back down, which I wouldn't be surprised if it does, purely because what I've talked about before with those lagged impact of monetary policy still in the system, you're going to see spending constraint for some time to come. But looking at some of these other major retail stocks, this is primary investment. So really, really strong downtrend here. When share prices really diverge from these moving averages and get a long way from them, just the law of mean reversion suggests that they do tend to rally back close to those before turning back down again. But the main thing here from an investor perspective is that, downtrend really intact there. Harvey Norman's had a really strong bounce, even though it came out with a profit warning last week. It suggests that a lot of that bad news was priced in. So if we're sort of saying, okay, well, what's not priced into retailers, it's a better than expected outcome in the next couple of months. But I don't think that's a high probability outcome. And while these trends are still in place, I'd be pretty cautious on them. Just quickly running through, this is Super Retail Group, crossed over here, so pretty decent downtrend. Levisa, it's had a really big pullback over the last couple of months, trending lower. Domino's, well, that's been in a downtrend for some time, so no real change there. This is Accent Group, shoe retailer, down considerably. Niscali, furniture retailer, down considerably, trending lower. Michael Hill, jewelers, clearly in a downtrend. Adairs, same. Beacon Lighting, the same. Maya had a really good run here, but just turned over completely. So that's just to update that. We're looking at 50% share price correction from the high in March. So that's pretty significant. Wesfarmers, which is one of the bigger, it's not really a retail stock, but it is in the consumer discretionary index. So that's sort of held up relatively well. And a couple of these other stocks we might look at a little bit later, but that's just sort of gives you an indication that the retail stocks have bounced a little bit this week, but those downtrends are well entrenched. And from a perspective of how I sort of look at investing, certainly wouldn't be looking to jump in on those. You want to sort of, it could be the bottom. There's a lot of bad news priced in there, and the valuations look reasonably attractive. But I tend not to want to buy into a sharp downtrend. You want to see a bit of buying support come in, bit of stability, and the trend to at least stabilize and move sideways for a good couple of months before taking a punt. So I think that sector is still a good few months away from any interesting investment opportunities.
Well, I did run a very scientific poll on the Twitter account for Monday Morning, and I said, are the retail stocks, bargains here, or is it a value trap, or is there going to be value in the next 6 to 12 months? And I think most people either voted for value trap or value in 6 to 12 months. So I think the market there, small sample size, but sort of corroborates what you're saying. But I think, yeah, I probably do think that it's probably going to get a bit worse for the retail stocks. I think when the the inflation data got broken down by categories, I think clothing and footwear was the worst performing one. It actually prices actually fell from May 2022 to May 2023. Clothing and footwear fell actually 0.4%, the prices.
I think
And
that
I
was
think,
about the only category to
yeah,
show price declines, wasn't it?
yeah, exactly. Uh, well, I think we had this discussion off camera, but what did you make of the job vacancies side? Because I think you're a big advocate that it's a lagging indicator and we shouldn't really care about it too much. Whereas I was sort of thinking, oh, those numbers are quite crazy and quite strong.
Yeah, I guess employment is not being an economist. I try to put as an investor. I try to put weight on forward-looking
Hmm.
indicators rather than lagging indicators. And when it comes to employment, everyone knows that employment market is really tight,
Yeah.
and you generally don't see a pickup in unemployment until the slowdown is well
Hmm.
entrenched. So it's a tricky one because if the RBA is looking at that as a key indicator of how it
Hmm.
should make its monetary policy decisions, then I think we should probably put higher weighting on further interest rate
Hmm.
rises. Um, yeah, but it's in terms of an indicator that I really sort of look at. It's not something that I consider a lot in terms of giving me clues on other things. Share prices are by far the better clue,
Yeah.
and I don't know if this is an indicator as such, but Seek, which is an
Hmm.
online employment portal, that share price broke down a couple of months ago. I think we showed it in one of the earlier
Hmm.
episodes, and the share prices continued to fall as well. So to me, that's more of a leading indicator on
Hmm.
employment rather
Yeah.
than the employment numbers, which are lagging.
Yeah. Do you reckon anyone in the RBA is looking at the SEEK share price instead of the unemployment rate when making their
Probably not.
decisions?
No. Who knows? I got no idea how the inner workings of a central banker goes, and whether there's whether they make their decisions based on the perception of what they should do. My general view of people in leadership
Mm.
positions in across all ranges of society these days is pretty low. So. Uh, and I think we were having this discussion in the business is that politicians and people like central bankers, when you're a leader and you're in a leadership decision,
Mm.
sometimes you have to do things that are not popular, and you have to build consensus through good solid arguments in order
Mhm.
to lead properly. And I just don't think we're seeing that in across the world in terms of the leadership that we're seeing in politics, certain institutions, those sorts of
Mm.
things. Uh, and look, the RBA for many years was considered a pretty good institution. I think on balance, it's probably not too bad. Like it's certainly not a job I'd like or many people would like because in an environment when uh, regimes change, like you go from 10 years of disinflation
Mhm.
and where monetary policy wasn't a huge impact. And then you have the pandemic, and then you have fiscal policy that was such a huge
Mhm.
injection of demand and liquidity at the same time as uh, monetary policy was. All of a sudden, central bankers are earning their money
Mhm.
because they've got to make some really tough decisions. Now, whether the tough decision is to continue raising rates because it looks obvious that that's probably what they should do,
Mhm.
or do they use some foresight and say, we have done what is it now 400 basis points of rate rises in a little over 12 months. We know that there's probably at least half of that still to flow through
Mhm.
into the economy, um, despite the headline numbers showing we should still be raising rates.
Mhm.
Perhaps we just need to step aside for a little while, and maybe put some pressure on the government to rein in its spending, because that's the other side of the inflation equation that doesn't really get a lot of publicity, and just because the budget is in surplus a little bit doesn't mean it's not an inflationary budget, because a lot of the money that comes in to the Aussie economy comes in through exports of coal, iron ore, gas, that sort of stuff. So that's an inflationary, because it increases national income. So it's really up to the government to run greater surpluses to try to keep that money out of the economy and stop adding to demand. And at the same time as that's happening, we've got massive spending programs for NDIS, and yeah, so the government has got just as much responsibility to look at the inflationary impacts of its policy as the RBA, but the government's keeping its head down on that front, so not surprising.
Yeah, well, definitely the Reserve Bank is an easy institution to sort of blame if you're the government.
Absolutely.
But I think before we sort of move on, I did sort of notice some interesting stats about the job vacancies, and it was the one that stood out to me was the May vacancies this quarter. I nearly doubled those in February 2020, so just before the pandemic. So if you look at it that way, the economy is probably stronger than it's ever been. But then I think a few days ago from ASIC, they were sort of saying that business insolvencies are finally on the way up. And I think they've hit their highest monthly level in more than 7 years, according to the latest data from ASIC. So it's a tough job because there's all of these contradictory indicators coming out. But I do think I'm sort of interested in the macroeconomic aspects of it. And I have been sort of looking at all of the different speeches and addresses that Fed officials in the US and our own officials in the Reserve Bank have been saying. And the employment rate is definitely something they're keeping a close eye on, because the thing they're worried about the most is services inflation. These days, goods inflation has sort of come down, but services inflation is what they're worried about, because it's still sort of elevated, and a big chunk of services inflation is wages. And if unemployment rate is at historic lows both here and in the US, they're probably scared it's going to continue to put pressure on wages growth, and that's going to keep services inflation high. And if that's what they think, then maybe they will probably keep interest rates higher for longer, and then that probably percolates to the stock market. So,
Yeah, absolutely. I mean, the higher for longer inflation story is something we've talked about previously as not being priced in to markets, and I think it continues to be ignored. And I think that's part of the frustration from central bankers. I know central bankers met in Portugal this week, and the major central bankers, and the main takeaway was that rates are probably going to rise a couple more times in the US. They're going to be higher for longer. Yet, and it's interesting just to sort of show this, because we've talked about it. We've talked about it in recent weeks. So let's have a look again. We've got the CNN Fear and Greed Index still on extreme greed. So the market is just saying, okay, Jay, whatever. It doesn't really matter if you're going to increase rates 1-2 more times. We're just going to continue to party. So from a contrarian perspective, this is my biggest concern, is that sentiment for the past 3 weeks, I think, has been in the extreme greed. And if you can see, just look on this here. A year ago, we were in fear. A month ago, greed, and recently we've been in extreme greed, and it's actually popped up a little bit from what it has been recently. And the reason why that's a concern from a contrarian perspective is because who else is there to buy when there's extreme sentiment in the market? It's the same as when there's extreme fear. It's like, who else is left to sell? So when that extreme greed is in and priced in, it just means that what's not priced in is a return to some sort of normal sentiment in the market, and that can come from anything. There's any catalyst can trigger a change in that sentiment. But when you're at the extreme greed level, it probably doesn't take much of a trigger to scare people and see them sort of come back to some kind of normal thinking and profit taking generally accompanies a move from extreme greed back down to a normal sentiment level. Whether we're 1-2 weeks away from that or another month away, I got no idea. But just at these levels, you have to be pretty cautious, as I said, from a contrarian perspective. If you're a short-term trader, extreme greed's probably good because you need that ongoing optimism to keep pushing prices higher. But I would argue that once you're at that level, it's probably pretty tough to get the next leg higher.
Yep, great. Well, I think now's the time to talk about gold, the most precious metal of them all. And I think the stuff that you're going to talk about is, I think, going to be very valuable to readers, because I think you're going to delve into exactly what drives the gold price. And I think there are maybe some misconceptions about what actually causes the gold price to rise or fall. I think there's a easy idea that, inflation is sort of directly linked to gold, but it's not exactly that. It's about real interest rates. So, Greg, take it away.
Righto. Well, yeah, this is, I guess, for some context, I've probably bought my first gold bullion back in 2003. So I've been involved in the gold market for
it's
about
20-year anniversary.
20 years. Actually, it's probably not far off. I think it was October 2023 from memory. And yeah, bought a chunk of bullion, started buying gold stocks because I was of the view that even back then, central banks were, I think that was around the time that they'd been cutting rates, and the economy and the financial system looked very unstable. So I thought gold bullion, pretty good hedge against that type of environment. So I've been involved in for it in 20 years. I've been a big gold bull. I've been a very blind gold bull where I just thought gold was going to go up and up and up. So I've had some moments where I've made a lot of money on gold, and I've lost a lot of money. So I've used those periods to try to dig deeper into the market to try to understand how it really works. And I think that period from, say, 2012 to 2015, which was a very, very big bear market for gold stocks, the sort of benchmark HUI, called the Huey index in the US, lost 80% of its value from the peak to trough around that time. And yeah, I lost a decent amount of money on gold stocks because I was purely just sort of thinking, well, yeah, gold's going to correct, but it's not going to do too much because the Fed's still, doing QE and all these sorts of things. So the more you look into it, or the more you experience these ups and downs, and the more you look into it, the more you realize that there's so much more going on with gold that you can never fully understand it, but you can try to have some sort of framework for investing in it. The other aspect that I'd probably want to point out is that a lot of people come to the gold market from a moral perspective. So they will moralize about the financial system and say, isn't it horrible, all the stuff that's going on? Aren't these bankers crooked? Aren't the central banks destroying the economies? I will insulate myself and become very rich from owning gold.
Yeah, which is very analogous to what some of the Bitcoin
absolutely
support.
Yes. Yeah. And it's just a different take on that same thing. And I guess I was seduced by that in the early stages purely because there is a level of righteousness in owning gold, because there's no one on the other side of the transaction. It's no one else's liability. It's your asset only. And you feel like you're insulated from the financial system by owning physical gold bullion. But the problem is that over the years, the commercial banks have essentially created a fiat gold system. So the amount of paper gold that trades in the market is enormous, and it dwarfs the physical trade of gold. So that tends to financialize the price, and it brings the gold price into the same orbit as all the other fiat money assets that are going on. So that brings me to the point of real interest rates, and gold tends to correlate very, very closely with long-term US real interest rates. So before we get into what that looks like, maybe it's worth just showing you the definition of real interest rate. So
Yep.
a real yield is the nominal yield minus inflation expectations. Now, I've underlined expectations because it's not minus inflation. Inflation, the numbers that you're getting are past inflation numbers. So what we want to do is try and look forward and say, what is the real yield based on forward-looking expectations of inflation? So to give you an example, today the real US 10-year bond yield ticked up quite a bit overnight. So 3.85% for the nominal 10-year bond yield, minus 2.2%, which is the long-term, the 10-year inflation expectation. So that gives a real 10-year bond yield of 1.64%. So that's just to give you an example of how you get to the real yield. Now, the long-term average real yield is a good inverse correlation with gold, and I'll show you some charts on that in a second. And the high for the long-term average real yield was back on October the 21st of 2022. And that was the highest since April 2010. So to put all that together, it's probably best that I show you some other charts that explains how all this works. So bear with me. And I don't want to try and make this too complex, but I think it is important to understand the different aspects that go into it, because at the end of this, I'll show you a chart that shows you just how much gold correlates with these movements. And if you understand this, you're going to get a much more rational view of how you should look at the gold price in US dollars, and therefore how you should think about investing in gold. So based on what we just said, there's a couple of different things you should look at. This is the nominal yield for 10-year bonds. So the nominal yields peaked in October 24th, and it's sort of been going in a sideways consolidation pattern over the past, let's say, 6 to 10 months. So that's the nominal yield. Then you've got what's called the 10-year break-even inflation rate. Now that's just a fancy name for the average expected inflation rate over the next 10 years. Now that peaked in April 2022, which was around this time of the Russia-Ukraine war. And I think that sort of escalated here, and everyone was thinking, oh, that's going to be inflationary. That's not going to be good at all. So these inflation expectations popped up to 3%, which was the highest in quite some time. But ever since then, these inflation expectations have been trending lower. Now, if we remember what the real yield is, it's the nominal yield minus these inflation expectations, which gives us the long-term or gives us the real treasury yield. Now, I've tried to make it longer term here to give you a sense of what's happened over the past sort of few months, or let's say few years, sorry. The real yields got to a minus level down here in 2021. So they were the most negative they've been in many, many years. When real yields are falling, that's bullish for the gold price. When they're rising, that's negative and bearish for the gold price. So if we look at a chart of gold overlaid with, or where I point out where the real yield correlation is. Now, this is looking pretty busy, but this is the gold price, the US dollar gold price. And I've pointed out where real rates have bottomed and peaked for their short-term moves to give you a sense of how well the gold price is correlated to the real long-term real rate. So when real rates bottomed,
Mm-hmm.
gold prices peaked. So that means real rates are rising while gold's falling. Now that here, real rates peaked, gold bottomed, real rates bottomed. I'm not going to go through all these, but it just gives
Mm-hmm.
you a sense of these really interesting turning points in the market where real rates have bottomed and real rates have peaked.
Mm-hmm.
Now, I'll zoom in a little bit because in recent times, these haven't really matched up with the peak or the bottom in real rates. So this was the Russia-Ukraine conflict, and that was probably a bit of an anomaly. And just here again, gold rallied post the collapse of the Silicon Valley Bank and the expectation or the feeling that the Fed was going to start putting liquidity into the market again, which it did, but on a very limited scale. So gold rallied on the back of that, and it's now coming back down, and it looks like it's starting to. I mean, this is still a decent upward trend, right? Like I'm not too concerned about the long-term outlook for gold at this point, but there is a bit of pressure on the gold price purely because real interest rates are still high. And if I go back to the real interest rate again, so the real interest rate has moved higher from this 2021 all the way through up to 2022. Now, if you remember, gold had a long bear market and it was pretty nasty, but it bottomed in October, September of last year. And then the gold price rallied significantly again. But the real yield has sort of trended sideways. So there's an argument to suggest that gold probably has a little way to fall if real yields stay at this level.
Yep.
So my contention would be that gold is pricing in a fall in real yields purely because gold is relatively close to all-time highs, whereas the real yield hasn't fallen a lot. So if, and this is a going back to the equation of what the real yield is, if inflation expectations continue to fall because the US economy is continuing to slow, yet the Fed keeps rates higher for longer, and that means nominal bond yields either continue to rise or stay high, then that means real yields will increase because you've got a falling inflation expectations and a stable to rising nominal yield. When those two things happen, in real interest rates will stay high or they can even rise further. So as much as I'm a long-term gold bull, I'm cautious in the short term because of this higher for longer mantra by the Fed, which will have the added impact of slowing the economy, which will slow inflation expectations. So we all talk about how inflation is being entrenched and inflation is sticky and all those sorts of things. But these 10-year average inflation expectations are not backing that up at all. So we're now down to 2.2% for the long-term inflation expectation. Yet everyone's talking about sticky inflation and how it could be higher. But the market is pricing in long-term inflation only a little bit above the Fed's actual goal of inflation. So if the Fed stays tight, if the Fed keeps raising rates, that could push nominal yields up and it could push inflation expectations down, which will push real yields up, which will pressure the gold price. And there's just one more chart I want to show you that gives you a bit of a relationship between real yields and the gold price, and that is this green line. These are called TIPS, and this is the Treasury inflation protected securities, but they're essentially the price of real yields. So this is a price in the same way. This is a gold price. This is not a yield. This is a price. So when real yields go up, prices go down, right? That's how bonds work. When a bond price and yield are inversely correlated. So because real yields have increased, real bond prices have fallen to reflect
Mm-hmm.
that increase in the yields. And over time, you can see this really good correlation between the real interest rate and the gold price.
Mm-hmm.
But it broke down here.
Yeah, why is there such a huge discrepancy?
Good question. This reflects the significant increase in real yields,
Mm-hmm.
whereas the gold price priced that in a little bit,
Mm-hmm.
but not a huge amount, and it's rallied back up here. So whether the gold price is saying the US economy, the global economy, cannot handle real
Yep.
yields at this level for much longer because of the huge amount of debt in the system, and it's betting that real yields will go back up here, or whether the gold price has just got this completely wrong and the gold price needs to
Mm-hmm.
fall as well. I'm not 100% sure. One thing to keep in mind is if this line stayed correlated, you'd have a gold price at $1,200 an ounce, and you wouldn't have many mines producing gold
Yep.
at a profit at that level. So the other aspect to this is that when inflation does flow through to the economy, it pushes up the average price level for everything. And this is why gold is such a good barometer for so many things, because the cost of mining an ounce of gold, I don't know what it is now. The average price is probably somewhere around $1,500 to $1,600 an ounce, right? So there's a margin here of a couple of $100 an ounce, a margin of profit of mining gold. If the gold price fell all the way back down here, you essentially wouldn't have much of a gold mining industry going on, and I think that's part of the reason why you're seeing this this discrepancy here. So if you move this correlation forward a little bit, it's not quite as dramatic as what it is if you try to do it from a really long-term perspective.
Yep.
And that comes back to this change in the regime from being a disinflationary environment where gold miners were mining gold and costs didn't move up a great deal for a number of years, to now there being an inflation shock in the system, which has pushed up the average price of producing everything. But that's been reflected in this higher real yields.
Mm-hmm.
But let's just push this correlation forward a little bit, and it's not as dramatic. So it's not as correlated here. It fell in this sort of main section here where if we look at what the date was around there, so that's really the peak of the inflation expectations, the Ukraine-Russian war, and then gold price and real rates increased and the gold price fell. So from here, the gold price has increased, yet real rates haven't really changed too much. So there is a little gap in here. So what's not priced in is the gold price hasn't priced in longer than expected real interest rates staying high. I think the gold market is expecting real interest rates to fall in the months ahead. Now, whether that's 3 months, 6 months, not really sure. The other thing to consider, ignoring all that, the other thing to consider is purely from the price action.
Yep.
Gold's bottomed here. It's moved into an upward trend. It's made a low here from a correction. If it makes a higher low, then to me, that's still a bullish looking environment. And maybe I need to think about a different interpretation. And from just another charting perspective, you've got a high here. So you've had 3 highs and gold's tried to push through that high and hasn't been able to do it. Whether it bottoms here and has another attempt, I think until it breaks definitively through these highs and gets into all-time high territory, you probably have to be pretty cautious on where gold goes from here, because in order for this to happen, you need real interest rates to start falling. And that would be a combination of nominal yields falling significantly, which would probably happen in a let's say pickup in unemployment, more recessionary signals coming from the US economy, or on the flip side, if inflation expectations started to pick up and nominal bond yields remained stable. that would be the other factor that would push real yields lower. But my sort of interpretation would be that nominal bond yields would come down significantly and inflation expectations would still fall in an inflationary environment, but perhaps not fall as much as the fall in nominal bond yields. So, yeah, look, I know that's a bit of a mouthful. Did that make sense, or is that too confusing for you? Is what did I or didn't I explain well in that? Because
No,
I
I
understand
think
it's a complex argument.
yeah, I do understand because I think you've sort of written about it before to your readers, so I've sort of been acquainted with that argument. But I think the more I sort of listen, gold becomes such an interesting investment. I think I wrote about this last week. It's usually assume when you invest in gold that you're sort of investing in this very tangible asset. You're investing in gold mines. You're investing in like the ore, but it seems to encompass such abstract macroeconomic factors as well that in a weird way you do have to be in a little way a mini macroeconomist, and you have to sort of bet which way inflation is going, what the biggest central banks are going to do. So it becomes a very complicated bet on the wider economy and markets as a whole. So it's
Well,
like
I think
almost
the simple way to look at it, is that it's a monetary asset,
yeah
and it is and it's a monetary asset that doesn't pay interest. So you have to look at it from that perspective, and its biggest competitor is the US Treasury market. So you have to match it up against the US Treasury market. And just for some perspective, the gold bullion market is I think you've got the US Treasury market's the biggest in the world. Then you've got the Japanese bond market, and then the gold market is the third largest asset market in the world in terms of the size of it, trading and all that sort of stuff. So it is still a very important asset, but it has been financialized to an extent where it's locked into the orbit of all the other fiat paper that's floating around the monetary system we have. So when you buy physical bullion, you have a pristine collateral asset with no one on the other side of it. You don't have to worry about counterparty risk, but you do have to worry about, from a value perspective, you do have to worry about interest rate risk. And if interest rates rise, then there's going to be pressure on the gold price, purely because it doesn't pay interest and opportunity cost. You could sell your gold and go and buy treasuries. Now, when you do that, you're taking on counterparty risk, all those sorts of things. So gold should have a premium based on that. And that's the other thing with that difference in the real yield that I pointed out. There does come a point where gold will separate from US treasuries the more and more insane fiscal policy becomes in the US. So it's getting to a point where deficits are just getting bigger and bigger and bigger. The interest bill on those on the outstanding debt is massive. And if the Fed Reserve at some point in, say, like the next 12 to 18 months has to turn around and say, we have to start QE again because there's no one else to buy and finance these deficits, then gold's going to separate from that equation, and gold could well break through into new all-time highs and just keep going. It could be $3,000, $4,000, $5,000 an ounce, which is why I think it's a really important asset to keep in your portfolio and keep an eye on, because gold bullion itself doesn't have counterparty risk in your own hands, and for that reason, gold miners can be quite valuable investments because they're producing the metal. So yeah, you're right. It's a complex investment, but I think maybe because I've had my head in it for 20 years, I just find it fascinating. I've always invested in it on and off to a certain extent, and I think as much as I'm concerned about the short-term outlook, if there's one thing that you can bet on, it's excess spending by the US government and continued deterioration of their finances, which will be bullish for gold longer term.
So would you say that, can you look to the gold market as a way as almost a leading indicator of real interest rates? almost to see
Whether
what the
it's
market
leading or
is betting on.
coincident,
Yeah.
yeah, and that comes back down to sentiment as well. How bullish, and we probably maybe one week we should have a look at the sentiment indicators for gold. I know
Hmm.
there's commitment of traders reports data that you can look at to see whether traders are net long or net short gold, those sorts of things. Haven't looked at it for a while, so I'm not sure where the latest is up to. Um, but I think gold is a very good indicator of monetary conditions. The real interest rates are at the highest they've been in nearly 10 years. So from that perspective, money's tight, but gold is saying it's not particularly tight because it's up near all-time highs.
Hmm.
But again, the interpretation comes down to, is it a straight interpretation of monetary conditions, or is it also an interpretation of the US fiscal
Hmm.
situation? And is the gold price looking out a few years and saying,
Hmm.
this is, because I think it was Stan Druckenmiller has been out over the past few months warning about the US dollar and
Hmm.
the insanity of the US government's finances and fiscal spending and commitments and those sorts of things. So if the US dollar is under the pump, then obviously gold and the US dollar operate
Hmm.
inversely as well. So the hedge against that is to buy gold. So that's another consideration.
Yeah.
Um, just
Well,
to wrap
speaking,
up on that,
yeah.
my view would be own gold, but also be very aware of its short
Yeah.
term impacts. And I think one of the short term impacts I wanted to point out today is that if real yields and the higher for longer
Hmm.
regime stay around for a while, gold could continue to be under pressure for a little bit.
Yeah. Well, because I think the naive view is that you can just buy gold and hold it indefinitely and everything should be okay. But there are peaks and troughs, and there are things that impact it. I think maybe I'll ask for a final word. I think we all know Rick Rule. He's a well-known commodities investor, and he said when he was asked what the real determinant of the gold price is, he said, "I think if you look at the real determinant of the gold price of the last 40 years, it's been the popularity or lack of popularity of the US dollar, and in particular the US 10-year Treasury." Now, would you say that's pretty accurate, or he should have added the real interest rate as well?
Well, he could have. That's a simple way of saying it. And
Yeah,
if you want to wrap gold up in a pithy statement, then you don't
yeah,
want to get into a real yield
yeah,
conversation, which we've done today. And we have the time and the charts
yeah.
to be able to point that out. But certainly, if you want to make it simple, that's a pretty good way to look at it.
Yeah, great. Well, now I think we'll turn to the final segment, which is the stocks of the week, and I think one of them is about cheese, and another one is about chicken. So we're going to talk
Cheese and
about,
chicken,
yep,
great way to finish
Bega
things off.
and Collins Food Group.
Yep. So these are the big movers for the week. I just thought it was interesting. We talked about all the retailers earlier on and how terrible they're looking,
Hmm.
whereas Collins actually looks pretty good from a charting perspective. It's had this big move down, bottomed here at the end of last year, uh, put in a higher low here, and it's had a really
Hmm.
strong rally to new highs, and these moving averages look like they're turning up. My only issue with Collins is, apart from the horrible food that it sells, it's trading on a forward PE of 20 times, a 3% divvy yield,
Yeah.
um, and a 2.8 times price to book value, and its return on equity is only, not only, it's around 14%, which is not too bad, but I think it's not an outstandingly profitable company, and those multiples just tell me that it's probably not the best value. So interesting from a charting perspective. If you're a trader, you'd probably might want to pick this up on a pullback
Hmm.
after this. I think that looks like a short covering rally to me. But I wouldn't be sort of buying this from a fundamental value perspective. And just the last one, Bega, I thought this stuck out at me this week when I was looking through the charts. Bega has broken down to a drum roll.
Wow,
Whoa,
it's
10
nearly a
year
10-year.
low.
Yeah, yeah.
Hasn't been there since 2013. Um, Now, I think there was some news out during the week about, well, you'd mentioned before the employment situation. They were saying
Hmm.
that they're struggling to get enough workers on the farms to milk the cows and
Yeah.
stuff, and they're looking at a across a lot of farms, the lower dairy cattle count, so that has an impact. But just in general, I looked at their numbers. I mean, they've got a forward return on equity of 2 point something %, which you can get in a bank account these days, and you don't have to take on any risk. And the price to book value is only trading a little bit below book value. So if you're and book is another word for equity. So if you're buying this company, you're effectively locking yourself into a business return of 2%.
Yeah.
So this should be trading, if those numbers are borne out, this should be trading at a lot lower price than what it is. And it's not surprising to see it at a 10-year low. So who knows? It could be the low. It could be a great buy. But generally, when stocks are breaking down to that level, you want to steer clear.
Yeah, well, I think with the bigger one, I think it highlights that old saying that stock can, just because it's gone low, it can still go lower, and that's been going.
There's always another 100% fall.
Yeah, exactly. It seems like its stock hasn't aged as much as a good cheese. That's a pretty bad joke there.
Nice one. Well, as long as we're not talking about a wine company, you can't really sort of pull that one out again.
Yeah. But I think with Collinsford, I do also find it strange that it's gone up because it's still losing quite a lot of money on Taco Bell, which is its other major chain. So it's sort of relying quite a lot on KFC. And I think there was a UBS analyst that sort of said, he's sort of positive on the stock because he thinks KFC is going to benefit from customers trading down. But KFC prices aren't exactly cheap. So if people are really going to trade down, they're just going to pop to Coles and get like $1 pasta can or something. They're not exactly going to go to KFC, but that's just my take on it.
Well, I think just one other thing on that. If they were to, and I have no idea, I don't follow the company closely, but if you were to sell the Taco Bell franchise and just make it essentially KFC, then that would, yes, you'd maybe take a hit on the asset that you're selling, but it would create a much more profitable standalone franchise because you're not carrying the losses that they're currently carrying with Taco Bell. So sometimes when you've got companies that do have divisions that are loss making, when they get rid of those divisions, it frees up the profitable division and increases things like return on equity and makes the remaining company a lot more valuable.
Yeah. So are you saying that Collinsford might sell Taco Bell?
No idea. Could do. Or they might want to keep investing in it to try to build scale and make money out of it. But that's just a throwaway comment to say that that would be a way of increasing short-term profitability if they wanted to do that.
Yeah, and it's definitely a good point. But well, thank you for all of that. I think the gold discussion was, I think, very valuable. I think not a lot of people actually are aware of exactly what drives the gold price, and I think given the complexity that you've sort of talked about, it's understandable. So maybe any final words from you?
No, just that I hope that it wasn't too complex. I think the difficulty is when you've had your head in something for 20 years to then try and explain it simply to someone who may have an interest in it but only a passing interest. Hope it didn't put you off, and hope you got something out of it.
Yeah, and let us know in the comments what else you would like to talk about. But thanks for tuning in, and see you guys next week.
Thank you. Thanks, everyone.
See you later. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.